Where the Central Bank of Nigeria is standing by.
Good afternoon, distinguished members of the press, ladies and gentlemen. Happy New Year to you all. The Monetary Policy Committee, the MPC, held its first meeting for the year 2022 on the 24th and 25th of January 2022 in the light of waning 2021 and a positive outlook for the fourth quarter of 2021. This is hinged on the continued support of both the monetary and fiscal authorities to sustain the current momentum. The committee reviewed the developments in the global and domestic economic and financial environments in 2021, as well as the outlook and risks for 2022. 10 members of the committee attended this meeting. In the short to medium term. This is driven by the persistence of supply-side disruptions and pent-up demand associated with recovery from the virus. In the emerging markets and developing economies, inflation has also remained high due to a combination of persisting exchange rate pressures and supply bottlenecks associated with lockdown restrictions. With the US Fed and other advanced economy central banks now moving towards monetary policy normalization, the eventual lift-off of interest rates may likely trigger a huge capital outflow from the emerging markets and developing economies, which would further aggravate exchange rate pressures with a pass-through to domestic prices. Global financial markets data shows significant sell-off as investors continue to rebalance their portfolios with a shift from assets such as gold and emerging market securities to advanced economy securities, suggesting market response to the impending interest rate lift-off. Global financial conditions are thus expected to tighten as risk-averse portfolio investors reassign their portfolios from perceived riskier emerging market securities to less risky advanced economy securities with the expectation of improved yields. The domestic developments. Staff projections show that the economy is expected to remain on a path of positive growth given the impressive performance during the third quarter of 2021 and continuing rebound in economic activities. Committee noted with satisfaction the significant improvement in the Manufacturing Purchasing Managers Index PMI, which rose to 52.0 index points in December 2021 compared with 50.8 index points in November 2021, reflecting the continuing economic recovery. This expansion was driven largely by increasing business activities in the economy, leading to increase in new orders and uptrend in employment and production levels. The non-manufacturing PMI, however, declined marginally to 48.0 index points in December 2021 from 48.6% points in November, largely reflecting a decline in services. Committee noted with concern the slight increase in headline inflation year-on-year to 15.63% in December 2021 from 15.4% in November, following 7 consecutive months of decline. The unexpected increase was attributed to both the food and core components, which rose to 17.37 and 13.87% in December 2021 from 17.21 and 13.85% in November, respectively. Committee, however, expressed confidence in the bank's sustained intervention programs, noting that inflation will continue to abate as food supply improves. Members also noted that the seasonal drive in price development associated with the December festive period was largely contributory to the marginal increase in price levels, and as such, believes that this episode of increase in December may indeed be temporary. Reviewing the developments in monetary aggregates, Committee noted that broad money supply M3 rose further to 13.77% in December 2021 compared with 10.10% in November 2021. This upthrust was largely driven by the growth in net domestic assets (NDA) of 15.58% in December 2021 compared with 9.4% in November 2021. Net foreign assets, however, decreased to 6.06% in December 2021 compared with 14.98% in November 2021. The sharp growth in net domestic assets was largely attributed to an increase in claims on the federal government and other sectors. The slowdown in growth of net foreign assets resulted from a decrease in foreign assets holdings of the banking system in favor of more domestic investments. Committee reviewed the performance of the bank's various interventions aimed at stimulating productivity in the manufacturing and industries, agriculture, energy and infrastructure, healthcare, and micro, small and medium enterprises between November and December 2021. Under the Anchor Borrowers Program, the bank disbursed $75.99 billion to support the cultivation of over 383,000 hectares of maize, rice, and wheat during the 2022 dry season, bringing the cumulative disbursement under the program to $927.94 billion to over 4.5 million smallholder farmers cultivating 21 commodities across the country. All excess outputs aggregated from the financed farmers will be released to the Nigerian Commodity Exchange to help moderate the prices of food in the market. The bank also released $1.76 billion to finance 2 large-scale agricultural projects under the Commercial Agricultural Credit Scheme. In addition, the bank disbursed the sum of $151.23 billion under the Real Sector Facility to 15 additional projects in agriculture, manufacturing, mining, and services. The funds were utilized for both greenfield and brownfield projects under the COVID-19 intervention for the manufacturing sector and Real Sector Support Facility from differentiated cash reserve requirements. Cumulative disbursement under the Real Sector Support Facility currently stood at 1.4 trillion naira, disbursed to 331 projects across the country. As part of its efforts to support the resilience of the healthcare sector, the bank also disbursed 498 million naira to 2 healthcare projects under the Health Care Support Intervention Facility, bringing the cumulative disbursements to 108.85 billion naira to 118 projects comprising 31 pharmaceuticals, 82 hospitals, and 4 other services. To support our households and businesses affected by COVID-19, the bank disbursed 20.29 billion to 40,521,000 beneficiaries, comprising 35,340 households and 5,181 small businesses under the targeted credit facility within the period. The cumulative disbursement under the targeted credit facility (TCF) stood at 369.78 billion to 777,666 beneficiaries, comprising 648,052 households and 129,614 small businesses. To further promote entrepreneurship development among Nigerian youths, the bank disbursed 293 million naira to 59 beneficiaries under the recently introduced Tertiary Institutions Entrepreneurship Scheme (TIES). Under the National Mass Metering Program, the sum of 47.83 billion naira was disbursed for the procurement and installation of 857,026 electricity meters across the country under the scheme's Phase 0. We also note the improved collection by discos as a result of the increased meter installations. The bank also released 254.33 billion to power sector players as part of its efforts to support the sector under the Nigerian Bulk Electricity Trading Payments Assurance Facility (NBEDPAF). This was in addition to 20.58 billion naira released to distribution companies under the Nigeria Electricity Market Stabilization Facility Phase 2. To further support the development of the enabling infrastructure in the gas industry, the bank released additional 3 billion naira for the augmentation of an existing infrastructure, bringing the cumulative disbursement under the intervention facility for National Gas Expansion Program to 42.2 billion for 6 projects. Furthermore, under the 100 for 100 policy on production and productivity, which was introduced to stimulate the flow of finance and investments to enterprises and projects with potential to kickstart a sustainable economic growth trajectory, accelerate structural transformation, promote diversification, and improve productivity, the bank has received notifications or applications for 224 projects valued at 294.91 billion naira for real sector projects in agriculture, energy, healthcare, manufacturing, and services. The applications are currently being processed, and the first batch of beneficiaries under the intervention will be announced and advertised in the national dailies on 31st of January 2022, with their names published in national dailies. These projects have been carefully selected in line with the approved selection criteria as contained in our guidelines. Money market rates fluctuated within and above the asymmetric corridor, reflecting prevailing liquidity conditions in the banking system. The monthly weighted average open buyback (OBB) rate increased to 12.75% in December 2021 from 10.61% in November 2021. The increase in the open buyback (OBB) rate reflected the tight liquidity conditions in the banking system. The MPC noted the continuing positive performance in the equities market in the review period, with the all-share index and market capitalization increasing by 1.61 and 1.63% to 42,716.44 and 22.3 trillion naira on December 31, 2021, from 42,038.60 and 21.94 trillion naira on October 29, 2021, respectively. This positive performance reflects improved corporate earnings as investors increase participation in the market. The MPC also noted the sustained resilience of the banking system following the progressive improvement in the non-performing loans ratio from 5.10% in November 2021 to 4.85% in December 2021, a first in a long time and indeed over many years. The committee also noted that the liquidity ratio remained well above its prudential limit at 41.3%, though capital adequacy ratio declined marginally to 14.53% in December 2021 from 19.90% during the previous month. Committee thus urged the bank to sustain its firm regulatory surveillance. Bank's members noted the continued improvement in the external reserves despite ongoing exchange rate pressures. The reserves stood at $40.2 billion as of December 2022. Our outlook. The broad outlook for the recovery in both the global and domestic economies is clouded with uncertainty as the resurgence of the COVID-19 pandemic, driven by new and mutating strains of the coronavirus, persisting supply bottlenecks, high and rising inflationary pressures, and dwindling monetary and fiscal stimulus. Emerging markets and developing economies are likely to experience a sharp downturn as a result of the identified headwinds confronting the outlook. This is hinged on the back of the ongoing two-speed recovery of the global economy, driven by continued disparities in the administration of vaccines between the advanced economies and the emerging markets and developing economies. Whereas the advanced economies will also experience a downturn in 2022, this group of economies are expected to take a less severe hit, as most of them have achieved significantly high levels of vaccination within their communities. Star forecast project output growth at 3.1% in 2021, with an expected better outcome in 2022, consistent with the expected improved macroeconomic performance. This is predicated on expected headwinds which continue to impact global recovery. The economy is, however, expected to progress gradually, with the recovery with ongoing support by the monetary and fiscal authorities, progress with COVID-19 vaccination, and continued high crude oil prices. After a moderate increase in December 2021, headline inflation is expected to trend marginally upwards in the short term before moderating towards the end of the first quarter of 2022. This moderation is expected as food harvests progress towards the end of the first quarter of 2022, thus improving food supply. In general, with the bank sustaining its intervention programs through the year, food inflation is expected to trend downwards in 2022. Available forecasts for key macroeconomic variables for the Nigerian economy indicate expected rebound in output growth for most of 2022, sustained by ongoing broad monetary and fiscal stimulus. Accordingly, the Nigerian economy is forecast to grow in 2022 by 2.86% CBN estimate, 4.2% Federal Government of Nigeria estimate, and 2.7% IMF estimate. Committee's consideration. Committee assessed the balance of risks confronting the domestic economy in the near term as they impact output growth and price stability. Members noted the unrelenting effort by the monetary and fiscal authorities in mitigating the impact of the virus on the economy. It observed the continued moderate recovery of the domestic economy, but requires further concerted policy effort by both the monetary and fiscal authorities to improve the momentum and strengthen their recovery. Members were thus of the view that building on the improved growth in the third quarter and the positive PMIs in the fourth quarter of 2021, output growth is expected to strengthen into 2022. On the pandemic, MPC reviewed its continued impact on the domestic economy as members collectively agreed that the downside risks were still hindering the recovery. In this light, it commended the efforts of the Presidential Task Force on COVID-19 for procuring vaccines and continuing the drive to ensure that most Nigerians are fully vaccinated. On price development, members continue to express concerns about the impact of insecurity in farming communities on food inflation. Whereas headline inflation had been moderating for several months, committee believed that its recent uptick was associated with increased demand during the festive season and was thus of the view that the prices will return to the downward trajectory given the bank's ongoing interventions in the agricultural sector. On this note, members applauded the efforts of the bank with the recent launch of the rice pyramid, noting that these efforts to increase food supply and stem food inflation were in the right direction. Members, however, reiterated the key role of the federal government in providing the necessary security around the country, and particularly in the farming communities, to ensure that farmers and their produce remain safe and food supply is both boosted and uninterrupted. Committee also noted that the ongoing dry season farming will further improve food supply and dampen prices. Members noted the ongoing debate around the removal of fuel subsidy and suggested a robust engagement with the relevant groups in the country and afterwards follow a stepwise and gradual approach to ensure its moderate impact on cost of transportation and energy for individuals, households, and firms. Committee also noted the need to encourage the takeoff of our private refineries across the country in order to provide alternative competitive local supply source and reduce the need for government intervention to manage fuel prices for domestic consumption. In addition to this, urge the speedy conclusion of the government gas-powered vehicles conversion scheme and other alternative fuel-powered sources. On exchange rate, committee applauded the management's efforts at maintaining stability over the short term with increasing demand as the economy continues to reopen. Members noted the dwindling proceeds from oil sales, despite rising crude oil prices. They further noted the need to address the persistent reduction in remittance of oil revenue to the Consolidated Revenue Fund and urged the NPC to urgently address this annually. This improved foreign exchange supply will further support the bank's demand management strategy in the foreign exchange market and consolidate macroeconomic performance, especially those that promote export, reduce dependence on import, and reduce foreign exchange demand pressures. MPC welcomed the improvement in foreign capital inflow through diaspora remittances and urged the bank to further extend the incentive scope to attract more remittances to official channels. The committee noted the rise in government debt profile and the concentration of the funding sources and its implication for fiscal sustainability and macroeconomic stability, including its impact on financial system performance and growth. MPC continued to urge the government on the need to harness other sources of revenue to reduce its dependence on oil as a single revenue source. In addition, it reiterated the need for government to seek alternative and more viable and indeed more efficient infrastructure financing sources in order to ease its expenditure burden. To this end, members called on the fiscal authorities to take advantage of the private sector-driven vehicle for the Infrastructure Corporation of Nigeria in order to transfer viable infrastructure projects for consideration by the corporation, as this would ease pressure on government in its drive to raise revenue through taxes from an already burdened private sector and household sector. The improved performance of equities market during the review period signposted continued investor confidence in the Nigerian economy. This, in the view of members, was a positive sign that the economy remained on a path to a more robust medium-term recovery. The banking sector indices in the consideration of members showed no less resilience as other macroeconomic indicators reviewed, even as obvious downside risks associated with the pandemic continued to impact the business environment. Members thus applauded the management's efforts in ensuring the continued downward trend of the non-performing loans ratio, signifying improved conditions in the banking system. Nevertheless, members emphasized the need for the bank to closely monitor developments in the sector and swiftly respond to any emerging challenges. The committee's decision. The MPC observed with concern the moderate rise in inflation in December 2021, noting that this was typical of increased aggregate demand associated with the end of the year festive activities. Members, however, expressed their continued commitment to drive down domestic prices by putting in place relevant policy measures to curb the rise in inflationary pressures while also supporting the fragile recovery. In its determination as to whether to hold or loosen or tighten its policy stance, MPC was mindful that whereas the US and some advanced economies have signaled their intention to commence policy normalization, which may result in capital flow reversals for the emerging market and developing economies, The major focus of these climbs were targeted mainly at reining in the high level of inflation, which had been unprecedented in the last 4 decades in those climbs. For Nigeria, members were of the view that Nigeria is confronted by not only inflation, but also fragile output. As a result, MPC believes that its current stance of price and monetary stability, conducive for growth, remain desirable. The MPC is convinced that various measures being implemented were helping not in boosting output growth, but also in moderating inflation. MPC therefore enjoined management to continue to use its development finance tools to accelerate output growth, which would also help in boosting manufacturing output that would ultimately help in moderating prices. It also requested management to continue its use of administrative measures, including discretionary tools at its disposal through the CRL to control money supply in the economy. In its final consideration, the committee was clear that a loosening option was not desirable because it would trigger further liquidity surfeit and fuel inflationary pressure, as available funds may outstrip the economy's absorptive capacity or domestic capacity utilization. It also feels loosening could trigger foreign exchange demand pressure, as the excess liquidity will be channeled to either frivolous importations or speculative holding of foreign exchange as alternative investment channels narrow, leading to foreign exchange depreciation and or inflation. MPC also dropped a tightening option at this meeting in view of the fragile state of the current gross domestic product growth rate and potential external and domestic headwinds confronting the economy. MPC also feels that tightening could truncate the steady improvement in credit performance, including other financial soundness indicators, and reverse the declining trend in NPLs. Moreover, MPC feels tightening could counteract the CBN's credit expansion motive as a necessary condition for improved economic growth and employment generation. The MPC therefore concluded that a hold stance remains desirable at this time, as this would indicate a conservative but cautious and consistent policy choice given the prevailing economic conditions and outlook, thus strengthening the policy credibility and focus. It also feels that a hold would signal MPC's realization of the fragility of the growth recovery and its sensitivity to emerging global and domestic uncertainties. Hence, the need to sustain policy trajectory. After a careful balancing of the benefits and downside risks of each policy option, MPC decided to hold all policy parameters constant, believing that a hold stance will enable the continued permeation of current policy measures in supporting the recorded growth recovery and further boost production and productivity, which would ultimately rein in inflation in the short to medium term. The committee thus decided by a unanimous vote to retain monetary policy MPR at 11.5%. In summary, MPC voted to retain 1. MPR at 11.5%, 2. Retain the asymmetric corridor at plus 100 and minus 700 basis points around the MPR, 3. Retain the CRR at 27.5%, and 4. Retain liquidity ratio at 30%. I thank you most sincerely for your attention.
Good afternoon and Happy New Year, Mr. Governor. My name is Nduka Chejin of the Nation newspaper. You are very aware of the US and other advanced economies adopting normalization policy of raising rates so as to tighten and mop up forex liquidity. Why is Nigeria monetary policy not following this lead, given that there will be large forex outflows?
To withdraw them from the economy by raising rates. You are very correct. That is true. Normalization will naturally lead to capital flow reversals, particularly for the emerging markets and developing economies. Because usually, as a result, some of those funds that were released into the advanced economies during the period of COVID-19, some of them actually flowed into the emerging markets to boost foreign exchange liquidity in the emerging markets. But let me say that whether you call it fortunately or unfortunately, but I'd rather use the word fortunately for Nigeria, when those flows were moving to the emerging markets at a time when the advanced economies were offering stimulus into the economy, those flows did not come into Nigeria. And indeed, since almost or more than about 2 years ago, what we have been doing is to see to a gradual and systematic and orderly exit of foreign portfolio investors out of the country, because they feel that the yields are not as high as they expect, and they also expect that there should be some more hedging instrument that will protect them in case they want to go out. You all recall that in the last 2 years or so, the Monetary Policy Committee had adopted a policy of price and monetary stability that is conducive to growth. And if we're talking about price and monetary stability, monetary policy position that is conducive to growth, it not necessarily means that the CBN or the monetary authorities had to adopt a somewhat policy of accommodation that brings interest rates to a low level, right? That will attract borrowers or people who have projects to embark on projects. And that is the reason you would have seen that we have aggressively, in the last 2 years, we have aggressively seen an increase in loans, whether to households or to small businesses or to large companies, at no more than 9%, and for 10 years. The essence of this is that we believe it will help to boost manufacturing output, it will help to boost agricultural output, and that has been instrumental in us achieving, in reversing the recession, reversing the contract of recession, and then increasing output growth, even while at the same time we're doing everything possible to moderate inflation. So what am I saying in essence? The funds that will be leaving as a result of policy normalization from the advanced economies did not come to Nigeria, and so as they withdraw them, there is nothing to withdraw out of Nigeria because we are not part of that game. So I'd like to assure us that it's not affecting us. However, another stand will say, what has happened as a result of, or what caused the policy normalization in advanced economies is because of rising inflation. And I must say that it is the truth that inflation has attained unprecedented levels in these economies. Is it in America? Is it in Europe? And I'll read some, for instance. The US inflation rate attained 7.08%. This happened to be the highest since 1982, unprecedented. The UK inflation attained 4.2%, which is the highest since 2010. In the EU area, inflation attained 5.5%, and it is the worst since the European Central Bank and the euro was created. So you would imagine that if these unprecedented levels of inflationary pressure in these economies, they do not have a choice but to really think of how to aggressively rein in inflation because of the liquidity surfeit they see in the environment, and they need to rein in prices to a level that is acceptable, because most of those governments are already facing the threat of even losing their next election as a result of rising prices and inflation. But for us in Nigeria, like I read, our challenge is not just inflation, but also growth. And this is a policy we've been adopting in the last 2 years. And if we feel that this policy is working well, there is no reason for MPC to begin to contemplate a policy of tightening because we see that we are somewhat moderately tightening the liquidity system through our administrative controls using CRR discretionary powers that we have. So I think that's the reason we feel MPC thinks that we will continue to do what we're doing now, because we believe it is giving us the results that we expect. Let's not forget that as a result of these policies that we've adopted, price stability that conducive to growth, we saw a reversal from recession after 2 quarters. As a result of the policy stance we've adopting, price stability conducive to growth, we saw inflation moderating consecutively for 7 to 8 months until we saw inflation uptick in December 2021. So monetary policy thinks, unquote, that this is temporary. What happened in December is temporary. It is transitory. But there's a need for us to look at it again and monitor it. Because we saw in December 2021, both the core and the food trending upwards. We would have expected that even food should still be trending downwards. But of course, we're looking at it, we think that it will be reversed because the harvest for 2021 was very, very good. But we have noticed a few challenges that we will address over time. So nothing to worry, because those countries that are raising rates, or even if there are some emerging markets that are following them by raising rates, those economies are indeed facing pressure, because they will, if they are not already, facing capital flow reversals from the economy. So we are not in that game, and that is why we are not following them in that direction. We want to remain where we are right now, hold, watch, because we believe what we're doing is working well.
Secondly, with inflation beginning to move up, should we expect any signaling soon that rates may move up to rein in inflation? Thank you.
Second question from Changing and says that with inflation beginning to move up, should we expect any signaling soon that rates may move up to rein in inflation? Like I said, we're trying to do everything possible to make sure that we don't go in that direction, because we believe in what we're doing. Last 8 months, we've seen inflation moderating. We believe that what happened in December is temporary, and we have looked at various issues. And primarily about is that why do we see prices going up? MPC looked at it, but we will look at it again in the coming meetings. We found out that prices at farm gates are in line with our expectation because they are somewhat moderated. However, prices at the markets, where our statisticians take their survey, are high. So if prices at the markets are high, there is therefore some problems between the farm gates and the markets. So we see logistical problems, essentially bordering on transportation, essentially also bordering on maybe destruction of food produce or perishable items from farm to market. And we're trying to see what we can do. And that's why we're trying to encourage people who are interested in looking at how to resolve the logistical problems of delivering food from farm to market to come in and take advantage of some of the interventions that we have. We feel that holders are here playing their games. Those who buy and hoard wait for dry season for prices to go up so they can take advantage at the detriment of innocent Nigerians. Luckily, we started a program last year where we said for our own repayment of our loans under the Anchor Borrower program, we will receive the produce into our own silos and our own warehouses, and we will dispose them and sell them to the real end users, whether it's the millers, the rice millers, or the feed millers who need them to produce, so that through that mechanism we can be seen to be competing with the others in the market to moderate prices. It worked well in 2021 because between February and about August 2021, the central bank released on a monthly basis 50,000 tons of maize monthly through those we recognize as the feed millers, and I'm sure the feed milling association, they saw that this actually helped in moderating the prices, because if we didn't do what we did between February and around August 2021, it would have been worse than we saw. We also have aggressively ensured that the Nigerian Commodity Exchange really comes alive. Luckily, the exchange is under the control of the CBN. A board will eventually be inaugurated, and they will run independently, but we will give them all the needed support for them to play the role they are supposed to play as a large commodity exchange that can hold different produce in our country and be able to compete with those who think they have some money that they go and borrow from banks and begin to hoard products for their own advantage when we get into a dry season. So we are ready for it, and I can assure us that the prices will not accelerate the way people are expecting. We are looking at all the issues involved, and I'm sure by the time we come into the next monetary policy, we'll have good stories to tell about the trend. But I think the issue remains that we see logistical challenges in moving food from farm to markets, from farm gates to market, and also the activities of hoarders, and we are going to do everything possible to stop this.
Good afternoon, my name is Uche Usim of the Sun Newspapers. Congratulations last week for your rice pyramid.
Which newspaper?
The Sun.
Sun, okay.
Yeah. I'm concerned about talking about the price of rice. It's still very high. What are you going to do about that? Why is it still very high despite this revolution? Thank you, sir.
The third question from the Sun talked about the rice pyramids and how come prices are not coming down. Again, I want to say that the rice harvest 2021 farming season remains very good. In the past years, we hear about flooding here and there, but at least through the whole of 2021, we never heard about flooding. We believe that the output and the harvest remains very good. I think the process, like I said, is how to gather the output in a productive and efficient manner so that this food can move. About the rice pyramids, we did it to test our will, and those who feel it can hold paddy. But I can tell you that what you saw in those pyramids is just a tiny fraction of the quantity of paddy rice in our possession. And I'm saying that we will aggregate them, we'll continue to aggregate those rice paddies, and we'll sell them to millers, and we would like to appeal to the millers that they should also be considerate. We're going to look at every transportation logistics that they're looking at, but Nigerians must receive rice on their plate, in their dining tables or in their dining rooms at moderate prices, and we'll walk through this, and that is assurance we give Nigerians.
Also, since the launch of the e-Naira in October, what is the status of that project today?
The fourth question talked about the e-Naira, asking for some updates about the e-Naira. They like to know updates. Honestly, I did expect it, the question, because we still have doubting Thomases about the e-Naira program. But let me say that since its launch about 3 months ago, Nigerians have continued to gradually adopt e-Naira as a fast and reliable means of exchange. While transactions recorded range from P2P, that is person to person, or person to merchant, P2M, bank to person, person to bank, and bank to merchants, and merchants to bank, the person to bank and bank to person constitute 90% of what we see in the market. And as you would have observed, we spent the last 3 months observing and monitoring the system and addressing issues mostly around initial onboarding. Transactions of the system have been super fast and remain free for now by design. The e-Naira is account-based, which means it requires a digital identity. The system was opened for the banked, which essentially means one would need a BVN and an account number to be able to create a wallet. Stringent validation procedures were enforced to preserve the integrity and security of the system. We feel that you must have a BVN and you must have an account to be able to access it. And we also find that this has created some kind of constraints on people about onboarding with BVN and the rest of them. But again, we believe that what we did by the use of the BVN is the best so as to avoid fraudsters from hacking into the system. Most of the complaints received were mainly around the inability of prospective users to onboard and activate their e-wallets due to a mismatch of BVN enrollment records. The bank has therefore been working to simplify the process of updating such information together with Niger Interbank Settlement System, NIPS, and the Deposit Money Bank. Considerable progress has been made with the release of locked accounts for re-onboarding. It is also now possible for foreigners to onboard as long as they have a BVN. I'm also happy to announce that with the recent assignment of the e-Naira USSD code by the Nigerian Communications Commission and the Ministry of Communication and Digital Economy, and we thank them, Nigerians without a smartphone who represent the majority of the population will soon be able to onboard and conduct transactions using e-Naira by dialing code 997. In line with its initial desire to create an ecosystem where innovation will thrive, the CBN is engaging with the fintechs and other industry players to create a bouquet of products on e-Naira platform. While transactions on the system have so far mostly revolved around moving money to and from bank accounts, tests with licensed payment services providers are ongoing to enable payments using e-Naira on e-commerce platforms. This will enable small and medium enterprise businesses and other commercial service providers to offer their products and services and accept e-Naira as a means of payment and exchange. As part of our commitment towards meeting our targets for financial inclusion, we are also working on a framework that will leverage the existing and new infrastructure to soon extend the services of e-Naira to the unbanked. Notably, CBN, together with its stakeholders, intend to embark on a rigorous awareness campaign to create the necessary understanding of the operations of the e-Naira. So those are the things we are doing on e-Naira, and we remain very, very optimistic that we are on the right course.
Good afternoon, Governor. My name is Biodun Derek from Radio Nigeria. You made mention of the 100 for 100 policy program. Please, can you throw more light on the companies that have been selected and what to expect soon?
The 100 for 100 policy, like I read in the communique, we received about 294 projects. They have been assessed, and I'm told that about 60 of those projects have been validated as okay and good to go. But what will happen, like we said, it's a promise that must be kept, that on the 31st of January 2022, we'll announce the first set of beneficiaries under the 100 for 100 program, and Nigerians, they will be publicized for Nigerians to know who they are, what is the employment generating capacity of those businesses, what is the raw material sourcing capacity of those businesses locally, because we're saying that the essence of the 100 for 100 project is to source fund projects that will create employment and stimulate employment, fund projects where raw materials, after installation, raw material content will be very high locally and import content will be very, very low or indeed close to zero. So we would announce that there's not a problem.
The first question is around cyber crimes, because you mentioned the financial system earlier. Cyber crimes have been on the rise. Cyber attacks globally costing about 6 trillion in 2021. What is the CBN doing to protect the financial system about that?
Question from Nancy talks about cyber crime in Nigeria. Well, let me say that protection of bank customers or users of banking or financial services remains very, very important and sacrosanct in our lexicon in the CBN. I'm aware that there is the Association of Infotech Directors or Heads in banks, and they continue to exchange information about cyber crime issues or emerging matters in cyber crime, and how the criminals are moving and how we can stop them. But I'm sure we all know, and we can attest to the fact that cyber crime has reduced considerably in Nigeria, and we will continue to do everything to ensure that this doesn't happen. Now,
then the second one is the rise of loan sharks too in Nigeria. We understand that loan sharks are neither regulated nor registered. Many Nigerians have been victims. I've seen people even lie to me personally on that. So what's the Central Bank of Nigeria doing to check the activities of the loan sharks?
On loan sharks, what we have done is to say that there is no need for you to go to a loan shark to look for a loan. People normally will go to loan sharks for loans because they're desperate, they cannot access the banks. And we find in this group mainly people who are vulnerable, the small people's households who need some small amounts of money to do their business, but they cannot access bank finance. As a result, go to loan sharks who charge them. If, for instance, you took, say, 100,000, and they tell you in next 90 days you will repay 200,000. Those are loan sharks. It's like twice the amount, two times of the principal just within 90 days. If you don't, they seize your property or seize your bicycle or seize your television to collect 200,000. We can only just continue to advise that there is no need for you to go to loan sharks, because fortuitously the central bank has put in place the avenue through which you can raise your finance. Is it through a targeted credit facility, or is it the small and medium enterprise businesses that we have set up through our national microfinance banks? You don't have to know anybody. Just get onto the portal, fill the form, send your data. If your data is correct, you will be able to access loans. And we have large number of testimonials about people who have accessed the facility without knowing anybody, and they have benefited from it. So I can only just advise you not to go to loan sharks. I want you to know this. You say, what is CBN doing to stop loan sharks? I can assure you that if we know them, if we see them, we will deal with them. But they reside in the rural communities. We are not policemen. But when we find them in an organized setting, we clamp down on them and we deal with them ruthlessly. But I can only say that don't approach loan sharks. Go to institutionalized loan institutions to take your money, so that when there's a problem, we can reach them to deal with them.
And what the CBN will do concerning inflation, I know you've talked about it earlier, but we know that the purchasing power of Nigerians have been eroded in the last 2 or 3 years. Average inflation last year 16%, that is still high. What is the CBN going to do to manage inflation to 2022? Thank you, Governor.
Nancy, you also talked about what specifically is CBN doing to rein in inflation in 2022. I've highlighted all this. Commodity exchange, do everything for that to make sure that we remove the logistical challenges in delivering food from farm to market, transportation, logistics, and the rest of them, to ensure that we really deal with the core side of it, on the food side. And on core, we are using administrative mechanisms to see what can be done to control money supply. I believe with this, we should be able to achieve some results in 2022.
Now, one colleague Nweke at Nation newspaper, and his question is, there are reported cases of the scarcity of naira at the banks, especially lower denominations. What is the true situation and what is the CBN doing to address this?
Somebody else has a question about scarcity of naira in the banks. I do not, that's cash now, particularly low denomination. I have to own up here. I will ask our guys in banking supervision to go and investigate it. But we know that the CBN delivers cash to the banks. Okay, starting this way. Nigerian Security Printing and Minting Company prints and mints cash for the CBN. And CBN circulates cash to the banks. We will try as much as we have to force the banks to come and take those cash and to dispense to their customers, particularly low denomination. So I do not see any problems, but this is an information that we're going to take on board, and I'm sure my colleagues that are here that are dealing with those will look at them immediately.
Bamidele Ogumwosi of Daily Independent. Mr. Godwin, there are concerns about the increase in the volume of non-performing loans, NPL, in the Nigerian banking sector, which are said to be threatening the operations of some of the banks. What is the current status of NPLs and the banks safe? Thank you, Governor.
The last question talked about NPLs, that NPLs are rising. No, we don't agree. NPL is not rising. In fact, the committee reviewed the banking sector financial soundness indicators. The banking system financial soundness indicators remains very, very excellent. The banking industry remains strong and resilient, and they are doing their best. NPL, for instance, in the month of December, dropped to 4.85%, the lowest in almost 10 years. And we intend to continue to sustain it. So NPL is not rising. I also disagree with you here. I hope I have the right to disagree with you. I have the data. Thank you very much, and see you in the next 8 weeks again.
Thank you, Governor. With that, we've come to the end of this press briefing. And I urge all of you to keep it safe, wear your mask, and observe all the COVID-19 protocols. Thank you, and God bless.
In Mombasa hasn't